when we're talking to allocators today, those who are coming back to China, we're all aware the global hurdle rate is pretty high. Risk-free rate is somewhere in the neighborhood, still about 5%, et cetera. So when we talk about alpha, that's one angle. But we're also talking about this hurdle rate that's incredibly difficult to beat. In China now, with rates as low as they are, you have domestic demand kind of filling that spot for managers raising capital. What are investors demanding offshore coming into China? Obviously, very punchy returns. Are they more focused on vol adjusted? Are they more focused on absolute return? How do you deal with those questions?
Alvin, you mean investor global investing in China market? And my angle is I would pitch 3 different strategy, depends on liquidity. The less liquid one, and those would be, I would call it a China call option opportunity, in which we are seeing that's happening, meaning that for global asset manager or global allocator who actually buy equity stakes in some of the China asset manager. So if you buy 10-20% of the company, if they grow when the market rebound, the valuation or the P&L contributed by this equity stakes could be phenomenal. This is quite popular in the global space. A lot of big funds, they're doing that. But I'm saying that this is a call option type of return profile for global investors who want to participate the China asset management industry, wealth management industry, or even the pension fund system. Because those asset managers are going to grow in assets. So point number 1, China call option type. You buy equity stakes in some of the Chinese asset manager. This is really appealing, in particular during the consolidation stage. I know some of the mutual fund, they're trying to sell or trying to invite some of the global institutional investors to be their strategic shareholders as well. I think this is, to me, the pricing is really undemanding and the timing is good when you want to capture the rebound. So number 1, China call option type. Number 2, I've described China counter-cyclical, which is the real estate sector, but the lockup is a little bit longer, less liquid. But I think the good thing about it is the margins of safety is very high because you buy it at a distress, you remodel, and then you sell it. And then the third one is exactly, Alvin, what you mentioned is the so-called China alpha type. I don't think when investors come back, if they're looking for beta exposure, I think the mutual fund, to be honest, or the long only, the ETF, or some of the sector fund launched by the mutual fund company is good enough. Because the valuation is super cheap. We always, as a fund manager, always think about why you have to pay 15 and 20% of the performance fee for a beta type product. So now, if you come back to China for the high return profile, I would say on the equity side, some sector funds, some ETF is the place to be. There are some nimble guys, they actually act like an absolute return fund, but they are only charging management fee. So this is a part of the return profile that I would suggest investors to come in. And then for those who don't want to tag along too much beta during the China of light economy slowdown, then I would say this multi-strat or alpha or convertible bond type of strategy would make sense because they can achieve low double-digit return profile and with a limited downside. So basically, you don't have to time when the market will rebound in China. It could be a year and a half, it could be 6 months or 3 months. But at the same time, the downside part is more solid. Of course, you have to pay a little bit on the performance fee, but given the sentiment in China market, I don't think the manager is demanding a huge performance fee at this stage. So I think it depends on risk appetite, return profile, and liquidity. Those are the 3 levels of investment opportunity I'm seeing in China right now for global investors.
Yeah, I think that's pretty refreshing, actually. I see a theme that fee compression in China for managers is slowly catching up to global standards. I remember 5-10 years ago, not only would we see just 2 and 20, we would see tiered performance fee pricing where the first 20% will be charged at 20%. The next 20 to 30% on top of that will be charged at an accelerated rate of 30%, and so forth and so on. So it sounds like it's a humbling experience for some of the managers, but it's actually healthy for the market because investors really shouldn't be paying, as you say, that much for beta. I want to talk about capacity constraint. So this is something that some of our more sophisticated allocators are asking for. They're looking for capacity constraint strategies. But at the same time, for us as investment managers, we're trying to grow the asset base as well. So there's always going to be a capacity issue. And so I see managers shifting, starting off with a flagship product that is capacity constraint and then shifting to a more liquid strategy for larger allocators, right? For your GROW product, the one that you're going to be launching in this coming year, are you focusing on capacity constraint strategies or are you looking at scalable products?
Well, I think we are in a quite fortunate position that some of the strategy we launch and manage in the early days are very forward-looking. So we want to run the portfolio as if we are running a $3 billion portfolio when we build the whole process. I'm not a strong believer that if you launch a product, the capacity is 300 million or 500 million. Basically, you should bring the team to a family office and let them own it at all when it's not totally scalable. And liquidity risk is also another concern. If a strategy, the capacity is 300 million US dollar, basically it's telling you that when there is no opportunity, it's hard for them to liquidate their portfolio. So every single strategy we launch or every team we bought in, we're talking about 3 billion US dollar plus of capacity in the underlying when the market grows. The good thing about China is liquidity come very quickly and growing in future. For example, in the equity space, convertible, there is no convertible bond transaction like 5 years ago. But right now, it's about a quarter, 25% of the market turnover of the China A shares. And China A shares alone, we are talking about 1 trillion renminbi of volume every year. And this is like 10 times more than the Hong Kong market. So I think having the QFII global access to the China market is kind of like very liquid, strategy. Of course, when we nail down to some of the CDA, commodity trading advisor, some of the contracts, like they can trade apples. I think those are less liquid, and this is not something that we do as well. So short answer is we want to have a scalable alpha strategy. And to be honest, this is not hard to find as long as you find the right team, the proper portfolio, not just going through the really concentrated, unique or small cap or trading Apple's future. This is not the direction that we wanted to be. And I don't think investors should invest in those strategies as well.
It depends on the type of investor, of course. Some investors like concentrated strategies. To your point earlier about concentration, would the fund to fund be limited to a number of managers that you've picked, or would it be inexhaustible in terms of how many managers? Because similar to, whether you do 2x2, 3x3, you could probably run the same type of performance on 50x50, right? 50 names by 50 names or so. When you look at a fund of fund, would you take a similar sort of concentrated approach to building the portfolio?
I think right now we are multi-strat. We don't call ourselves a fund of fund because going down the road 3 years, you would expect the industry consolidation in China will move very fast than most people expected. And some of the mid-sized, although some of their return would be top tier, they will struggle to grow asset or survive. It's not because of the capacity. It's because of the regulations, access to clients, operation, risk management, and the cost for them to retain their talent, etc. So we are in a very good position that instead of a fund of fund, we are able to, if we invest in external manager, use a managed account approach. When the market is good, those managers, they don't even talk to you. Invest in my commingled fund or in my flagship fund. I don't want to give you transparency. But right now, the bargaining power for allocator in China is very, very large. No matter unique strategy or mid-sized strategy, in particular with some global investor base, because they want some stable longer-term money. So in which our approach is to directly open and manage account and then ask them to trade on our platform, in which we have a real-time risk management, transparency, and execution. I think this is the future. That's why at this point we are launching a so-called a multi-manager global platform type of product in the China market because the bargaining power is on our side.
So it's not a fund of funds. It could potentially be a fund of managed account, but it sounds like there's flexibility for investors or allocators to choose where they want to allocate the capital to in the underlying.
Exactly. Through QFII, they can invest in this platform and then 100% transparency on the underlying manager. They can choose and pick and commingle. I would say this would take away some of the operation, corporate governance, risk concern by the allocator when they want to access the China market. Although most of the fund is being administered by custodian regulations, etc., but this is not the exact structure that some of the global allocators used to invest in Cayman or in other part of the world. So this full transparency managed account platform enable them to see the underlying in which they have a higher comfort level. And I think GROW, what we are trying to do is, given our global shareholder background, we are backed by two very large institutional investor, Lighthouse, one of the largest fund of fund in the world, and Julius Baer, one of the largest wealth management company in the world. And myself, as you mentioned, Alvin, being a board member in CAIA, and heavily involved in SBAI. I think that part of corporate governance monitoring part is being done by GROW. I think that create an access together with OPIM for global investor to really get into the true alpha opportunity or unique strategy in the domestic China space.
Yeah, I completely agree. The opportunity set is indisputable. It's definitely there. The pain point I think we're trying to solve with investors is the corporate governance, risk management. Not to say that it doesn't exist, it's actually quite robust, but it needs to be translated into a manner that offshore investors appreciate, right? And sometimes, just not to say that we have more stringent policies, it's simply adding a layer of reassurance, whether it be real-time risk management or whether it be creating liquidation policies where we want to protect alpha as much as we generate it. When you look at the appetite for China right now, and this is stepping back a little bit, US allocators, at least our experience, US allocators still very, very nervous about it. European allocators are a little bit warmer. Where are you marketing right now? Are you marketing in the Middle East? Have you gone back to the US? Or are you focusing on European investors right now?
Yeah, good point, Alvin. I think, to be honest, the sentiment for global investor towards China is very bottom and low level, as you can see in the public information, right? So the flow, northbound flow, and then some of the event. But the good thing about it is, in my experience, is sometimes it can turn when the number turn as well. If you remember early on this year, in February, everyone is excited about China, and then the figure come out and then go back. So I'll break it down group by group. In the US, we are actually having regular dialogue with some of the US endowment and pension funds. I think they are not totally kind of like write off the China space or write off the China market. But what they need is more data to support their thesis within the investment committee. And also, to be honest, they need some return to come back. Because in terms of the return profile, US strategy and US manager this year in particular did very well compared to Europe and Asian and China managers. So I think that is also a factor, not just China centric. But going forward, when I talk to them, what is their most worried thing about next year is they also realize the Magnificent Seven, how long can those trend be? And they're also thinking about what would be the next scalable growth opportunity or bottom fishing opportunity. And I would say most of them actually agree China is the space to be. So I think a lot of US guys, they are doing some background work or trying to increase their coverage again in China, but not writing immediate ticket. I think European would be in similar cases in that regard. But having said that, I found European investor a little bit more quicker, in particular the family office compared to the US pension fund and endowment. So I'm expecting Q1 and Q2, maybe the European investor will coming back quickly. I'm going to Europe in mid-December, trying to tell them what are the opportunity in the China market, and I'm happy to provide an update on it. Middle East actually is a new bright spot for a lot of China manager. I've known a lot of friends who go to Middle East, come and go. It need us to spend much, much more time because some of the manager actually, they go to Middle East for the first time. It's all about mutual understanding, right? So it's a new market for the China manager to go raise asset. I believe in Middle East investor has huge potential. And I do see complementary opportunity between Middle East investor investing in China and vice versa. So that's why ranking the three countries or the three places, I would say the recent trend for Chinese manager to raise asset globally, Middle East is the most popular space. But I think that part is also the most help much needed for both sides because I think from the allocator side perspective, they are quite new to China as well. Last but not least, I'm seeing some opportunity in ASEAN, Singapore, some of the family office there as well. I think they also realize the alpha opportunity or the call option type opportunity in the China market because they understand from their portfolio, China would be a growing important part of the portfolio. So those are the different area that I'm spending time. And lastly, Alvin, is you recall we talked about China last year and this year. The first message I sent out is buy a plane ticket, come and see. And I'm quite happy that over the last 3 to 6 months, actually we are hosting a lot global investor coming in China, pension funds, insurance company, family office, institutional investor. And I also talk to a lot of my friends in the industry as well who are trying to be an ambassador or hosting global investor in the China market. Most feedback from the allocator is they come away with a more positive note before they come in. So seeing is believing. So my message to our fellow viewers in this channel is try to buy a plane ticket. William will buy you a bottle of Mao Tai and bring you to see the regulator, a fund manager, and an entrepreneur. Seeing is believing. Being on the ground, I think there are different perspectives and opportunity that you find from not coming to China before.
I think that's a great way to wrap things up, William, and definitely advice that I would echo for our guests as well. Yeah, get a plane ticket, fly over here. You'll find that unlike what you've seen on mainstream media, it's not a third world country. It hasn't been for a while and isn't going to be for a while. In fact, it's really exciting, some of the opportunities here. And while others are fearful, this is the best time to be greedy. On that note, thank you so much, William. It's been an amazing conversation. Good luck with Grow. Good luck with the multi-manager platform. And we'll catch up on the next one.
Thank you.